As digital assets like cryptocurrencies, NFTs, and tokenized investments become mainstream, the risks associated with them, such as hacks, theft, and technical failures, are also rising. This has sparked a new wave of innovation in insurance tailored specifically for digital assets. Digital asset insurance is rapidly evolving to provide investors and businesses with much-needed protection and peace of mind in this fast-growing, high-stakes market. Today we'll explore how this emerging sector is reshaping the future of financial security in the digital age. Today we will talk about the rise of digital asset insurance. So before we start, make sure to hit the like button and subscribe to my channel. 1. Introduction to digital assets and the need for insurance. In recent years, the financial landscape has undergone a seismic shift with the explosive growth of digital assets. Cryptocurrencies like Bitcoin and Ethereum, non-fungible tokens, NFTs, decentralized finance, DeFi platforms, and other blockchain-based financial products have reshaped how value is stored, transferred, and traded. These digital assets, while innovative and promising in their potential to democratize finance, come with unique risks that traditional financial systems are ill-equipped to handle. Unlike physical assets or traditional financial instruments, digital assets are intangible, decentralized, and often stored in digital wallets, secured by cryptographic keys. The irreversible nature of blockchain transactions combined with the high-tech complexity makes the loss or theft of digital assets devastating and typically unrecoverable without insurance. This growing exposure has triggered a pressing demand for specialized insurance products designed to protect investors, institutions, and platforms from the myriad risks that accompany digital asset ownership. 2. Understanding the risks associated with digital assets. Digital assets, while attractive for their potential returns and technological innovation, carry distinctive vulnerabilities that are starkly different from traditional assets. One of the primary risks is cybersecurity threats. Hackers targeting cryptocurrency exchanges, wallets, and DeFi protocols have caused billions in losses. High-profile hacks, such as the Mt. collapse and the more recent Poly network breach, have illustrated the fragility of digital asset security. In addition to external hacking, there are risks of internal fraud, mismanagement by custodians, and human error, such as losing private keys or falling victim to phishing attacks. Technical failures in smart contracts, code bugs, and platform outages further complicate risk assessment. Regulatory uncertainty and rapidly evolving legal frameworks add another layer of unpredictability, making it difficult for investors to know their rights and protections. These multifaceted risks highlight the importance of insurance as a tool to mitigate financial exposure and foster confidence among digital asset holders. 3. Evolution of digital asset insurance products. The digital asset insurance market, although nascent, is rapidly evolving to address the complex risk profile of blockchain-based assets. Early insurance attempts often fell short, relying on traditional policies that did not cover cryptocurrency losses or contained ambiguous clauses excluding digital assets. However, dedicated digital asset insurance products have now emerged, featuring coverage tailored specifically to risks like cyber theft, custodian insolvency, smart contract failure, and regulatory fines. These policies are often underwritten by specialized insurers familiar with blockchain technology and its risks. Some insurers have also partnered with blockchain analytics firms to better understand transaction patterns and fraud detection, enabling more accurate risk pricing. Additionally, new product innovations such as insurance pools, decentralized insurance protocols, and parametric insurance models leverage blockchain's transparency and automation to improve claims processing and reduce fraud. This evolution is crucial in making insurance a viable safety net for digital asset investors. 4. Key players driving the digital asset insurance market. The digital asset insurance ecosystem involves a diverse set of players, including traditional insurance companies, specialized insurtech startups, blockchain projects, custodians, and institutional investors. Large insurance firms like On and Marsh have begun to incorporate digital asset risk advisory and coverage in their portfolios. Meanwhile, startups like Nexus Mutual and Insurace operate decentralized insurance protocols that allow users to pool risk and buy coverage in a trustless environment. Custodial service providers such as Coinbase Custody and BitGo often offer insurance coverage as part of their service to institutional clients, reassuring large investors about the security of their holdings. Additionally, blockchain analytics firms such as Chainalysis and CipherTrace provide vital risk intelligence that insurers use to underwrite policies. Institutional interest is also growing, with hedge funds, family offices, and venture capital firms seeking to mitigate risk exposure as they increase allocations to digital assets. The collaboration between these stakeholders is shaping the future landscape of digital asset insurance. 5. Challenges in underwriting digital asset insurance. Despite the growing demand, underwriting digital asset insurance remains highly challenging. The lack of historical data on losses and claims for cryptocurrencies and related assets makes risk modeling difficult for actuaries. The dynamic and fast-evolving nature of blockchain protocols also means that new vulnerabilities can appear suddenly, complicating risk assessment. Moreover, regulatory uncertainty, ranging from differing jurisdictional approaches to crypto assets to evolving compliance requirements, introduces legal risks that insurers must factor in. Moral hazard and information asymmetry issues arise when insured parties may not always disclose all relevant risk factors or take adequate security measures. Cyber risk itself is highly sophisticated and constantly changing, necessitating continuous monitoring and expertise. Insurers must also balance affordability with coverage comprehensiveness, as overly expensive premiums can deter customers, yet insufficient coverage can lead to disputes. 6. Impact on institutional adoption and market maturity. Digital asset insurance plays a pivotal role in driving institutional adoption of cryptocurrencies and blockchain-based financial products. Institutional investors, such as banks, pension funds, and hedge funds, often require insurance coverage as a prerequisite for entering the market, given their fiduciary duties and regulatory compliance obligations. The availability of robust insurance options reduces counterparty risk and enhances confidence in digital asset custody solutions. It also facilitates the development of regulated crypto funds, tokenized securities, and other complex financial instruments by addressing risk management concerns. As insurance markets mature, the digital asset ecosystem benefits from greater legitimacy and reduced systemic risks, attracting more participants and capital inflows. 7. Emerging technologies and future trends in digital asset insurance. Looking forward, emerging technologies are set to transform digital asset insurance further. Blockchain's inherent transparency and immutability can be leveraged for automated claims verification and fraud prevention, streamlining the claims process. Smart contracts can enable parametric insurance policies that pay out automatically when certain predefined conditions are met, reducing delays and disputes. Artificial intelligence and machine learning tools enhance risk assessment by analyzing transaction data and threat patterns in real time. The rise of decentralized finance also opens the door for community-driven insurance pools that democratize risk sharing without traditional intermediaries. Additionally, the integration of identity verification, regulatory compliance tools, and real-time risk scoring will improve policy accuracy and customer experience. 8. Conclusion: the imperative of digital asset insurance. The rise of digital asset insurance marks a significant milestone in the maturation of the blockchain economy. As digital assets become increasingly embedded in everyday finance and commerce, the need to safeguard them against theft, fraud, operational failures, and legal risks grows ever more urgent. Insurance solutions tailored to the nuances of blockchain technology not only protect individual investors and institutions, but also strengthen the overall integrity and trustworthiness of the digital asset ecosystem. By mitigating risks and providing financial backstops, digital asset insurance unlocks broader participation, spurs innovation, and bridges the gap between traditional finance and decentralized technologies. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.